Welcome to The Explainer. Today, we're digging into a really interesting one, Agri-Tech India. On the surface, it looks like a dream stock with this explosive growth. But once you start to peel back the layers, well, it gets complicated. It's a real puzzle for investors.
So, this is the big question we're trying to answer, right? Is Agri-Tech India this incredible turnaround story in the making? Or is it a massive warning sign for anyone thinking of investing? And trust me, the answer is not black and white.
Okay, so check this out. On one hand, you've got this just staggering revenue growth, almost 150% in a year. That's huge. But then you look at the other side of the coin, and they're still losing money. I mean, how does that even happen? How can your sales shoot through the roof, but you're still not profitable? To get to the bottom of this, we've got to go deeper than the headlines. All right, so let's start peeling back the layers of this onion. And the first place you always look, the financials. Let's decode what the numbers are really telling us. And here it is. This is that headline number everyone's excited about. You can see total revenue jumping from, 0.18 crore rupees in FY 2025 all the way up to 0.45 crore in 2026. I mean, at first glance, that's the kind of chart that gets investors really, really excited. But, and this is a big but, what happens when we zoom out? Well, the whole story changes. If you look at the last 3 years, their sales growth is actually negative, over 50% down. So that big spike we just saw, it starts to look more like a blip, an outlier, against a pretty worrying long-term decline. And this really brings it home. Let's look at FY 2026. They brought in about 28 lakh rupees from their actual business operations. But their net loss for the year, a whopping 94 lakh rupees? You don't need to be a math whiz to see the problem there. They're spending way more than they're making. So you've got to ask, where is all that money going? Well, a huge chunk of it, almost 40% of their operating revenue, goes to employee costs. Now, you might think, okay, that's normal. But get this, the company only lists 2 employees. 2! That's a massive expense for just 2 people. It definitely makes you wonder about things like executive pay, doesn't it? Okay, so the numbers look kind of strange, but the financials are only part of the picture. Things get even more interesting when we look at what's been going on in the boardroom. Just look at this chain of events, it's wild. It all starts in September 2025. Shareholders literally vote against reappointing a director. Bam. The next month, another independent director is gone. And then, a few months later, their auditor, the company whose job it is to make sure the books are clean, just up and resigns. One thing after another. This isn't normal. This screams internal conflict and a total loss of confidence from shareholders. Things got so bad, they had to call an extraordinary general meeting. And let me tell you, that name isn't for show. This is not your regular corporate meeting. It's basically an emergency session. You do this when there's a crisis. And having to scramble to replace both a director and your auditor at the same time, yeah, that's a crisis in corporate governance. So we've got questionable financials and boardroom drama, but it gets worse. Now we're peeling back the last layer, and honestly, this might be the most troubling part of the whole story, the legal and audit red flags. Remember the auditor that quit? Well, on their way out, they left a little parting gift. It's called a qualified opinion. And for any investor, hearing those 2 words should set off alarm bells. They specifically called out these loans between related companies where no interest was being charged. That's a huge no-no, potentially breaking the law. This is like your own accountant standing up and shouting that something is seriously wrong here. So what exactly is a qualified opinion? Think of it this way. It's not a thumbs up. It's not even a thumb sideways. It's the auditor basically saying, hey, we've looked at the books, but we can't give them a clean bill of health. They're telling you that the financial records might not be accurate or transparent. It's a massive warning that the numbers you're basing your investment on could be, well, fiction. And it's not just the auditors raising concerns. The company got slapped with a hefty penalty, 25 lakh rupees, from a major legal body, the NCLAT. So now we've moved beyond just questionable accounting. We're talking about a legal ruling with a very real price tag attached. But you have to hear the story behind why they got fined. It's truly eye-opening.
The tribunal looked into a case involving a related company and found that the whole thing was collusive. They said it was a move designed to undermine the interests of public shareholders. I mean, let that sink in. A legal tribunal is basically accusing them of fraudulent activity against their own investors. Those are about the most damning words you can get.
Okay, so let's take a breath. We got shaky financials, a boardroom in chaos, and some really serious legal trouble. With all of that in mind, there's one last thing we have to do. See how Agri-Tech actually compares to its peers in the same industry. This is where the rubber meets the road. And wow, the difference is just night and day. Take the PE ratio. For its competitors, it's positive. They're actually earning money. For Agri-Tech, it's a massive negative number because, well, you can't have a PE ratio if you don't have any any earnings. Then look at return on equity, a key measure of how well a company is using shareholder money. Its peers are creating value, 18%, 6%. Agri-Tech is losing value. And last, look at promoter holding. How much of the company the founders own? They're at about 31%, way lower than their peers. That can sometimes mean the people who started the company have less confidence in it. So let's put it all together. We've peeled back all the layers. What's the big picture here for a potential investor? It really comes down to this. You have this one really flashy number, that huge revenue growth. But you have to weigh that against everything else we've uncovered. You've got massive governance problems, financials that even the auditors don't trust, major legal issues, and just plain weak performance when you put it next to its competition.
So in the language of a professional analyst, how would you describe Agri-Tech? You'd call it a high-risk, speculative asset, and you'd say it's facing some serious governance headwinds. That's jargon for when the problems at the top, the boardroom drama, the legal stuff, are so bad that they could completely sink the entire ship, no matter how well the actual business is doing.
And that brings us right back to the question we started with. We all love a good comeback story, right? An underdog who turns it all around. But looking at everything we've seen today, you really have to ask yourself, when does a potential turnaround story stop being an opportunity and start being a risk that's just not worth taking?